Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's head of U.S. macro strategy. It's Tuesday, June 17th, 2025. Welcome back to the podcast, George.
Great to be on. Great to be on remotely with you.
Yeah, and welcome back more generally. As you know, you were in Tokyo visiting clients last week. We're in Boston doing that exactly today. So as you said, kind of cool to be recording this episode from the road with a number of interesting client meetings under our belt. As background for our listeners, we're recording this podcast on day one of the June FOMC meeting. Most of our listeners will be listening to this episode the morning ahead of the FOMC announcement, whether you're in Asia, EMEA, or in the States, or in the Americas more generally. So, George, perhaps wishful thinking, but I did have some hope that perhaps it could slow down a little bit after what I think anyone would characterize as an intense start of the year, navigating, a new administration, navigating tariff headlines, some significant changes in agenda, as well as your sort of typical day-to-day economic developments. Perhaps with the economy in flux, perhaps transitioning cycles, but that does not seem to be the case. Out of nowhere, we've gotten a pretty significant flare up in geopolitical conflict in the Middle East, starting late last week. That could obviously have major implications for global security, energy prices, etc. But enough from me. Let's hear from you. So uncertainty remains, a very perhaps overused word by market participants as well as policymakers themselves. But a lot has happened since our last episode, which I believe was a couple weeks ago, especially on the U.S. fundamentals front. Take our listeners through that.
Absolutely, and I think even though uncertainty might be overplayed or used, I should say, it is the appropriate word because it's really what we're dealing with. We're dealing with uncertainty in terms of the macro backdrop, global macro geopolitics, in the U.S. specifically, what's going on with the big, beautiful bill or, fiscal policy, more broadly speaking, and, trade policy and tariffs, all of that in and of, any one of those individual line items would be a major endeavor in times past, and it's all happening basically at once. Trying to make sense of all that is complicated, and I do think it results in in a world of like lower conviction, less activity, and sometimes more volatile swings in either directions. But having said all that, we've been really stuck in a range, right? We haven't seen markets really break out in one way or the other. Seems pretty volatile day to day, but not really making much progress. Specific to the U.S. macro front, which I think at least lays the foundation of how to think through what may come next, especially for the Fed, because all throughout that opening, we haven't really mentioned the Fed, and other than the fact that they're meeting, which we'll get to our Fed preview in a second. But the fundamentals matter still. We've been in a world where Q1 saw a lot of front loading and pulling forward of activity ahead of the tariffs. We've seen it in retail sales data continue to kind of soften here. The consumer probably has bought what they need, and or companies have pulled forward unfinished goods to kind of get ahead of the tariffs. You're seeing some sort of price adjustments maybe coming from the exporting nations to at least keep market share. And you're also seeing profit margins maybe take a little bit of a hit here as companies want to also maintain market share and not fully pass on the cost to the consumer. And meanwhile, we've had 3 months in a row of very low inflation, and we actually had a back-to-back 0.1s on CPI and PPI, which will likely result in a very also low PCE, the Fed's measure of inflation. And the jobs data, although beating expectations, but when you're beating low hurdles, that's not really saying much. And the actual composition and the underlying data has not been that strong. So we're seeing signs of the unemployment rate rising for the wrong reasons. People actually dropping out of the workforce, and the unemployment rate would have been much higher if that didn't happen. So I feel like we're in a the conditions are way different than they were at the March Fed meeting, the May Fed meeting, and we're definitely in more of a deceleration mode. And we can't just attribute that to soft data and sentiment. There's now some early signs of that weakness coming through, and I think it's in response to all these sort of big swings that we're experiencing both on the economy and policy front.
Yeah, that's well said. Yeah, my personal bias, looking at that employment report, the household survey itself did not look so hot. So I sympathize with you there. Away from the data, you mentioned this briefly, but we are watching the progress of the one big beautiful bill in the Senate. The target is to get that passed before the 4th of July. There continues to be this sort of lingering uncertainty of tariffs. I think at some point, people had kind of hoped that there would be certainty on tariffs, there would be agreements, and it just kind of feels like this could go on for a really long time, get an agreement locked down with one or a couple other nations, and still have a lot of variables elsewhere. So that seems to be something that's going to hang on the macro picture. Meanwhile, that situation in the Middle East is volatile. And if that is not resolved soon, that could add additional uncertainty. And that's, obviously in addition to a major ongoing conflict between Russia and the Ukraine. I guess the question is really like, how do all these different variables, which are, highly fluid, impact your view?
Yeah, so again, we usually have this framework, regimented approach that we're trying to get to understanding the Fed's reaction function, because we still think that rates analysis and just the approach we take is from a bottoms up, applying it to the yield curve, looking at term premium, looking at supply and demand dynamics. But the Fed still plays a crucial role in that. And so, we're thinking like in any other time period in the past, given all this uncertainty, typically the Fed would be sounding more dovish, but yet they've been really harping on more of the inflation concerns that could come, which is not guaranteed or not clear that's going to translate exactly one for one from the tariffs. That's really been the only reason why they're in a wait and see mode, because given all of these different competing forces, but a lot of them to the negative downside, the Fed would in the past would throw in a insurance ease for good measure to offset some of these potential negative growth shocks. And although there's progress being made, and the House has passed their version of the bill, and the Senate is basically almost done with theirs, I think moving towards conference soon, and they want to get it done before the 4th of July. And there's progress on the fiscal side. It's still very debatable how much stimulus are we really going to get. How much tariff revenue are we going to get to offset to pay for all this sort of fiscal largesse and expansion. So again, it's not clear that we're going to get an impulse that's going to be pro growth, and then the stuff that may be pro growth, like deregulation in the second half or into early next year, that hasn't really come to the surface yet. So we're really still in this sort of limbo. So it really still supports our view that the Fed is behind the curve, and they're purposely behind the curve up until now. And we'll see what they do at the upcoming meeting. And we do think it's a chance for them to pivot. So maybe we can kind of pivot our conversation to that too.
I like that. Right. Going exactly that route. Why don't you give us a preview of your FOMC, your June FOMC preview entitled "It's Never Too Late to Pivot." Obviously, that's a play on President Trump, who keeps on saying Chair Powell is too late and Chair Powell is behind the curve. So I guess the question is, the Fed's been pretty hawkish, heading into the meeting. They've made it very clear that uncertainty has them on hold and kind of waiting. So I guess the question is, will the Fed continue to lean on the hawkish side as they did heading into blackout, and continue to be worried about inflation rather than worried about growth? Or will this meeting see the Fed pivot and set the markets up for summer rate cuts?
Yeah, so typically we publish our piece, and hopefully everyone can take a look at it, and we have our typical scenario assessment and probabilities assigned to hawkish, neutral, and dovish messages, and any sort of shades of gray along those lines. Our base case is that we expect more of a neutral stance, no major changes to. This is also a quarterly Fed meeting, so they give us their quarterly projections, their SEP, Summary of Economic Projections. So we'll get their rates kind of assessment. We're going to get their views on growth expectations, inflation expectations. I think given it's the middle of the year and there's all this uncertainty and no one really knows where we are in the cycle and things could go a lot of different ways, that it behooves the Fed to maintain what they've had for quite some time, which is two cuts for 2025. There's plenty of meetings still ahead of us where they can either execute on those two cuts. We think they should do more, but at a minimum, the two. And if we're wrong and the economy were to accelerate from here, they have time over the course of the summer to kind of course correct as well. So like, why limit yourself? Because like the risk is that maybe they only go to suggesting one cut, which is exactly what they did last year. They, at the June 2024 meeting a year ago, they moved their forecast just for one cut that year, and they ended up delivering four, a total of 100 bips. I think that like there's no point in boxing yourself in. So staying flexible with the two cuts is our base case, and that Powell really doesn't want to rock the boat. Again, they lack clarity on so many fronts. So like, why would they want to move the market at this point when it's basically priced in for two cuts? Let's see how things unfold. That's probably like the best course of action for them to pick here at this point in time. I mean, like the risk to our views are that they do come out more hawkish because they are really worried about forward inflation, not just the fact that the inflation the disinflation that we went through, maybe that's in the rear view mirror and they don't think it's sustainable. And they're thinking inflation is going to accelerate from here because of consumer surveys, which again, I think is a little bit disingenuous because they've been telling us ignore the surveys, but they're only focusing on the inflation part, but not the growth concerns from the surveys. But anyhow, I mean, my issue with that aside, if they were to like raise or reduce the amount of cuts this year and the dots were to consolidate higher, that would be a hawkish surprise. And I don't think that the market's ready for that. And that could send some pretty big shockwaves through the markets, both in rates, but also in risk markets, which are kind of teetering here a little bit. Like, although they're at the local highs, you could say, hey, look, equities have been climbing the wall of worry and they're not worried about anything. If the Fed were to kind of throw like a hawkish hammer here and we're wrong with our assessment that now's the time to pivot, they could really create a big risk off into the summer. So I just don't see the Fed wanting to do that. They've purposely been behind the stage and they don't want to be front and center. I don't think this is the meeting to stand out, but they can slowly change the language a little bit and become a little bit more neutral and then set up for cuts later in the year.
And what about like they in addition to their dots, they also have like economic forecasts. I think you made a point in one of our client meetings where like had the labor force not declined, the unemployment rate would already be at 4.4%. Maybe talk our listeners through their kind of labor market forecasts and what might to expect there, and maybe some of the growth for inflation forecasts.
Yeah, I mean, look, if when they're doing their modeling, they have to be and they claim to be data dependent. So if the facts have changed and the data is suggesting that the unemployment rate is actually higher than what is being produced from just the mathematics of the ratios, like they know the underlying trends of the labor market is not really suggesting it's a 4.2 unemployment rate. It's more like a 4.4, 4.5. And if we were to see those sort of numbers, that's basically ahead of schedule for their own end of year targets happening towards the middle of the year, suggesting that there's more deterioration in the labor market than they first thought of. So if that's what they're coming up with and they're also seeing slower growth, that would mean that they would have to change their rate forecast to be even more dovish, not the other way around. So I think that the key here is like I really hope that they're really not feeling pressured not to do the right thing, and therefore they actually stick to the model-based assessment of like if growth is weaker, if unemployment rate is coming in faster than you expected, that should mean you should start pivoting towards cuts sooner, not later.
Yeah, it makes sense. And for our listeners, I would encourage you to check out George's June FOMC preview, again entitled "It's Never Too Late to Pivot, so long as it's to the dovish side." A lot of what George went over is in there, as well as more details. And if you are still not receiving George's strategy reports, do check out the MUFG research portal at www.mufgresearch.com, where you can find all of your favorite MUFG research, as well as sign up to have it conveniently delivered to your inbox. Great stuff as always. Thanks, George.
Thanks, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.